Greg, I'm going to start with you because to some extent fixed income bonds really drove a lot of the week. Explain what happened here, because we did have the Fed minutes, but we were getting increased rates even before we got to the minutes.
Yeah, so the markets were skittish before the minutes, and then the minutes came out, and as you mentioned, David, it basically reaffirmed what they said before. The surprise was, though, the balance sheet runoff. I think that did take investors by surprise. But what you really experienced this week was just a re-rating of the Fed. And so you've seen Fed hikes pulled forward, more aggressive over the near term. And I think the markets didn't like that, and appropriately so. And so today's jobs report just kind of cemented the view that March is a live meeting. Now, I think it's important to go back in time, though. So March wasn't even on the table contemplated, 6 months ago, 3 months ago, and now it's a live meeting. So it really is representative of how quickly the Fed has kind of shifted gears here.
So, Katie, over to you on the equity side. Equities might have reacted violently to this. I wouldn't say they did. The main story, I thought, from the week, you correct me, on equities was what happened with tech.
Yeah, tech had a very disappointing week of performance. Let me just back up and say that we have had the worst start to equity markets since 2016, and kind of big picture, we've had this 12 years of a great environment of rates going down and markets going up, and we're all kind of getting used to a new normal. And so that's played out in the volatility that we've had, and we're now down more than 1.5% year to date on equities. As you pointed out, the locus of a lot of that pressure has been in technology. The reason for that, and people have varying levels of familiarity, so I'll just say, is that when you look at tech companies, most of the value is far out at terminal value. So when the rate curve steepens, that part of the market sells off the most. It's really raising this question for everybody who's had a lot of capital allocated to tech. Is tech over? Is this the end of tech outperformance? We don't think that's the case. We continue to have a lot of capital committed there. We appreciate there's going to be some near-term headwinds, but very long-term, even medium to long-term, we know that even the companies in the value part of the market that are leading the market now, so take banks, for example, one of the number one things that they're going to spend money on over the coming years is innovating themselves on AI, cybersecurity, moving workloads to the cloud. And so we know that all companies, regardless of whether they're value or growth, are going to be doing a lot of tech spending, and that should actually accrue to these companies over the medium to long term. So we would encourage people to look at these dislocations as opportunities to pick up exposure selectively.
So, Greg, you mentioned the jobs numbers. Why don't you unpack that a little bit? What jumped out at you? One of the things that I noticed, obviously, was the increase in wages.
Absolutely. That was a clear focus from a market perspective. The headline number was disappointing, let's say, 199 new ads. But I think you have to look at the 4-month average, which is substantially higher. It's about 369. So what the market really looked at closely was the acceleration in wages. And so I will say we haven't seen those wages create kind of broader inflation pressures, but that's the worry. I think that's the classic economic worry that many have. And that's why you've seen the rhetoric really shift and get cemented around that March meeting being in play. So it's really about wages, as investors and economists in particular are worried about wages really kind of infiltrating the entire system, thereby creating broad-based inflation.
Greg, we can't talk about bonds really without talking about the yield curve. Tell us what happened with the yield curve this week, and did it tell us anything more? I mean, it did not, as I see it, flatten much more. At the same time, it already was flatter than it had been in a while.
Yeah, I was surprised. I have to be honest with you. I was expecting the curve to flatten out. It's my expectation that it will. I think the more pricing that you see in the front end, the bond market will continue to suss out and sniff out that the Fed is too aggressive here and throwing the economy into an unnecessary slowdown. So the curve has flattened a lot already. That was the story in the back half of last year. It's steepened out a touch thus far this year. It's been a real rate story because inflation expectations have also come down. So it's a little perplexing in my mind, but I do anticipate that if the market continues to pull Fed policy forward and more aggressive, I would fully anticipate the curve to flatten in here.
Katie, on the equity side, are you taking into account the extent to which wages are a substantial component in the cost structure at this point, if we're going to see increases wages continuing?
Yeah, and David, you and I have spoken about this previously, but we think this is another data point to support our view that we are having this kind of very large rotation of power, basically, from capital to labor, which I actually think is going to be long-term quite positive for the social cohesion of this country, for the growth trajectory, and from an investing perspective right now is extremely positive as it relates to the consumer, because we have a lot of pent-up consumer power. Good balance sheets, wages going up, that's good for the consumer. And so we do have a lot of capital allocated for our clients into the consumer. And in particular, we are focused on the millennial consumer, so the younger consumer, and their strong preference for experiences over things. So we like things like travel and concerts. And this data and news flow around the variant gives us opportunities actually to build into those positions, because they do sell off when we get fears around the pandemic, but we've seen this recovery because we think that preference is actually very long-term and very sustainable.
Greg, as far as we can tell, and it would be guesswork to some extent, do you think the Fed wants the wage rate increase to come down? Is that what they're doing in part with monetary policy?
I don't think so. I mean, they've talked about inequality and trying to deal with inequality, and I think that goes against that philosophy. So I really don't think that's the case. That shouldn't be the case. I think what they're worried about is this textbook situation where wages rise and therefore good prices rise. So I'm not necessarily convinced. So I actually am concerned that they're focused on the wage aspect of it, because I think it goes against this inequality story that they've been talking about. So it's a delicate balance. So it's easy to, criticize what the Fed is doing and possibly thinking, but the wage issue in my mind is an important positive development, not a negative one. And I think it's been flipped around unnecessarily.